welcome to the podcast, everybody. Thank you for joining me. Really nasty day here on Wall Street, and we're going to take you through some of the things. I'm already getting some emails about, is this the bottom? When do I start buying? All those types of things. And, of course, your situation is different than everybody else's, so I can't tell you specifically when to buy. All I can tell you is what I'm doing. And S&P, you can see a picture of it here, tried to rally a little bit, finished down on the day somewhere around 25 points. The Dow Jones finished down 240 points, and the Russell 2000 down about 15. So all about 1.4% across the board, pretty even today. The volatility index actually wasn't up that much considering what's going on right now, but you can see we tried to have a little bit of rallies here. But the thing I always watch is, especially intraday, look at the volume here when this was rallying. You know, this is not what reversals are made of. We typically do get intraday reversals, and that may happen again where everybody capitulates and sells, and you see it sell off really hard, but you will see the volume spike up at the same time. Then it goes up like that. Then this starts to come back down. We didn't see that at all today. And all we saw was the volume at the end of the day, which is pretty typical at the end of the day. You see that volume as people close out their positions one way or the other. But, of course, what we have going on is primarily fear of global growth slowdown. And if you take a look at the dollar, this is really the story lately, isn't it? The dollar started to ramp up in July and has gone up over 7.5%. And that 7.5% move has translated into a lot of disruption, not only in the commodities market, but all over the globe. And it's just had this big triple effect. So what's happening now is people are fearful of deflation. Nobody's talking about inflation anymore. People are talking about deflation. And deflation is a scary thing, isn't it? Because all we have to do is go back to 2008, and that deflation was unstoppable, uncontrollable. Nothing that the Fed can do about it. And they tried, but there's nothing that can be done when deflation starts, and that's the fear. So, we do have Draghi, and what is he going to do? And he will, is he going to implement a quantitative easing program? And if he does, then perhaps things start to stabilize. It may not be good for everybody, but that's what's going to happen if he implements that. So that's what markets are watching for right now. Of course, the Fed is still there saying we're going to raise rates down the road, but who knows? And, of course, now what they have in their back pocket is quantitative easing, right? If things get bad here, they can always implement quantitative easing again. Since they're just about to end it, they could restart it again. So we're watching that. But interest rates fell a lot today, down to 2.4% from about 2.5%. So a pretty big drop on interest rates as money, not only with the U.S. dollar going up, money's flowing into the U.S. and then it's finding its way into the Treasury bond market. Well, let's take a look at the S&P. We're at the bottom end of this channel, and I think a couple of things stand out to me. Number one, we broke the 100-day moving average back here in January. Remember in January, we had a drop of about 6% to start the year off. And then we had this V-bottom up to the top of the channel. And we've had a few sell-offs since then, nothing really major. And they've all kind of felt like this. I think this one, the only difference between this one and the ones we've seen in the past is, even though the S&P made a new high here, a lot of stocks did not. And if we take a look at the Russell 2000, you see the difference in the picture there. The Russell 2000 made a lower high, whereas the S&P made a higher high. So we've seen this divergence happening where a lot of stocks are not participating. In fact, we did a study today, a calculation, and we calculated that the average drop in the Russell 3000, which is 3,000, a little over 3,000 companies, the average drop is over 26% from their 52-week high. So a lot of stocks are already in bear market territory, and that's one of the things that we warn people about is when bull markets become bear markets, you start to see stocks go into their own bear market. And then you start to see sectors go into their own bear market, meaning over 20% declines. So, it could be the beginning of that, but that does not mean that the stock market has peaked just yet. I want to be clear about that, but it does mean that we need to watch that because that has to resolve itself. Otherwise, we could be at the beginning stages of the bull turning into a bear. But I still don't think that's the case. I still don't think we have enough active selling yet. I still think we just see a temporary pause right now, and it's causing prices to go down. Yes, you're getting some selling the last few days, but it's still not near the intensity that we would normally see. Now, when we do look at the Russell 2000, of course, we're back here at these old lows. So we're at support. So again, we should be getting some buying coming in pretty soon, especially when you look at the S&P 500. But I would suspect, based on this, that perhaps we're getting some exhaustion indicators that we look at getting close. So we actually went in at the end of the day today and we nibbled in our tactical strategy, which are our aggressive strategy. We actually bought a small piece of some large caps. And right now we're trying to buy baskets of stocks as opposed to individual companies. If you have some companies you like for investments, you can continue to add to those, because those, obviously you're getting that chance. There's a lot of companies being taken down right now, especially small caps are getting taken down because the ETFs, the broad baskets, are pushing down the stocks. It's kind of the tail wagging the dog. And so there's a lot of opportunities in small and mid cap stocks. But as a basket, I think if I want to buy something, I still want to buy large company stocks. And so we actually nibbled on some late this afternoon, right into the close. But it wouldn't surprise me to see the market open down tomorrow and then perhaps get some type of reversal. So let's watch that. But you do have this box is something that we need to watch, because the market could easily drift into this box where it breaks the trend that's been here for a while, clearly breaks it, and then we go and test the 200-day moving average. So we've broken the 50, we've broken the 100, which is the purple line, and now we're coming down to the 200 potentially. And just to let you know, that is about a 2% drop. And so not a big drop to get down to that 200-day moving average, but a lot of the indicators I look at are definitely oversold. They're oversold. Doesn't mean they can't get a little more oversold, but if you can avoid selling right now, the best thing to do would be to not sell. If you want to get out of this market, you don't do it when people are panicking and they're taking all the good stocks down with the bad. You do it when there's a bounce, and I think we'll get that relief rally. Because not only do we have, I think if you look at October right now, some interesting statistics in October. Since half the gains in the S&P 500 over the years have come in the fourth quarter. We've got a presidential cycle happening. We've got a lame duck president. All these things coinciding, and generally speaking, you get a very strong fourth quarter. So, and especially the fact that the stock market hasn't done much this year. Again, when we look at the Russell 2000, it's actually down, I think, over 6.5%, 7% for the year now. Most of the major averages are starting to become flat. So when you look at that, it sets up nicely for a rebound into the fourth quarter. So we need to watch, especially since we're getting oversold. Here's the VIX. And remember, when the VIX goes higher, people tend to freak out and they want to buy when the VIX is at this high level. It is at a high level right now, but I like to buy when this fear when it subsides a little bit. We haven't seen that. We've seen it continue to escalate. So yes, I'm nibbling on some things because I have some cash in our tactical allocation I want to put to work. But the big buy would come once this subsides a little bit and you start to see this turn down a little bit. That's what would cause me to want to go in and buy some. Again, even if that's for a trade for you, if you have cash, that'll be a good trading opportunity. But if you're wanting to get out of the market, this is one of those times where let everybody else panic, and then as it pops back up, then you start to sell. On the flip side, if you're somebody that absolutely can't afford any losses, first of all, you shouldn't have been in the stock market to begin with. But if you are, then you may be somebody that has to sell on the way down. That's just the way it is. If you take a look at gold, let me switch over to gold real quick. So here's the picture of gold. Tried to it was actually up today, up about 0.5%, and you can see it's at some longer term support here. So let's see if gold can actually make a run. Don't know what to expect out of gold right now. People are fearful of deflation, not inflation, so that's why gold's been going down. Obviously, with the dollar going up, putting pressure on gold as well. But the dollar again could be at an exhaustion level, which means commodities start to rally. Gold starts to rally a little bit, so we need to watch that over the next few days. But anything interest rate sensitive did okay today, meaning treasury bonds, TIPS did very well today, mortgage REITs did very well today, international type bonds did well today, some munis did okay. So watch that, but overall, like I said, really didn't do much. In the bigger picture, just more tactical allocation, because in the bigger picture, nothing has triggered me to either get more bullish or more bearish just yet, but certainly some of these things are closer of getting more bearish in the big macro picture than they were a few weeks ago. And it's because we've seen things like you take a look at junk bonds this picture of junk bonds is pretty nasty. Again, it made a lower high. So while the market, the S&P was making a higher high, the Russell was making a lower high, advanced decline lines were making a lower high, junk bonds were making a lower high, the discretionary stocks were underperforming consumer discretionary, underperforming consumer staples, and it went on and on. So there's some setup for that, but again, we need to see this play out. This is not something that happens overnight. It's a process that can take, several months. And I think if this does continue like that, then what will happen is the stock market, after it has an oversold rally, it may rally to even a lower high itself. If it does that and it comes up to something like that and then starts to roll over and we start to see the selling intensify, that would cause me even more concern. But for right now, again, these setups may be indicative of market rolling over, but I think there's still, at the end of the day, there's not a lot of places for people to go outside of the stock market in the big picture. And I actually think international is a much better value when you look at emerging markets than the U.S. is right now. So even though we're more weighted in the U.S., we are over time building our emerging markets and even frontier markets allocations. All right. If you want to check us out on Facebook, we're there. We're also on Google+. Don't forget eggerscapital.com. It's where you get the radio show, you get the podcast, everything right on there. We got free reports as well. And if you have any questions, feel free to shoot them my way. Take care, everybody. Have a good day.